Good afternoon. Thank you for joining us for today's webinar. We'll talk liquidity. My name's Sean O'Brien, the president of QwickRate, and I am pleased to be joined today by Pam Sarubi. Pam's going to walk you through the QwickRate marketplace. Pam, anything you want to say to the group before we get started?
I don't think so. We'll just get started and then I'll come in when we're ready.
All right. Thank you very much. So today, we're going to talk about how liquidity certainly evolved over certainly the last couple of years, and then certainly what we've seen this year. We'll talk about a few different things that you might be able to do. Some of these might be already known to you, but as always, the toughest part is executing on a plan or an idea. And so then if those don't work, then we can talk to you about how QwickRate might be able to assist with any liquidity challenges you might be having. And then finally, we want to, if you haven't noticed it, introduce you to the QwickBonds tab on our toolbar as well. So, it's really kind of amazing in many ways, what's transpired over the last couple of years. Certainly with the onset of the pandemic, there was a tremendous surge of liquidity that found its way into our banks. And we, really here at QwickRate, and I think, in most at most banks, right, you just didn't need liquidity, right? We certainly saw that here, that banks just were in no need of liquidity. And then, over the last 18 to 24 months, particularly starting in the fourth quarter of last year, we started to see signs of banks returning to the marketplace. A lot of reasons for that. And then, certainly all independently might not be a big issue. Collectively, they really potentially could start to put some issues and challenges on banks. And some of those, right, are just the obviously rise in interest rate risk that we're all experiencing with the, dramatic uptick in rates. The excess liquidity is rolling off for a number of reasons, whether it's competition, continued strong loan demand, underwater securities portfolios. Banks are starting to see their positions, move from excess liquidity to potentially, tightening liquidity. We'll address the underwater securities portfolios that a lot of us are experiencing. We'll talk about just the impact now of rising deposit costs. And then, as I said, right, there's been, really good continued strong loan demand, but it's hard to imagine, certainly with the run up in rates, that at some point that there's not a potential, blip. Hopefully it's short and shallow, but, historically, this type of rise in interest rates has brought on some credit issues. And so, again, what we've been seeing is those liquidity levels being high, inflation that, levels that we haven't seen in 40 years, a Fed that continues to aggressively raise rates to slow and turn the tide on inflation. But we've seen, non-maturity deposits grow at our banks, average balances grow. And it's in many banks, the mix between non-maturity deposits and CDs, has kind of lopsided. So, as we enter 2023, we certainly have some potential headwinds. This yield curve inversion certainly suggests by investors that they're more pessimistic about the future growth prospects. Certainly, one of the ways that the Fed, doesn't really want to say out loud, but, is certainly a result of raising the interest rates is to slow the job growth and to, in some sense, create some unemployment, just because the job market is really impactful in terms of running up inflation. The yield curve historically, when it inverts, has been a precursor of recessions. And if history is any guide, then this would suggest that we would start to normalize, and as that slowdown occurs and some unemployment happens, albeit from historically low rates, that could potentially create some credit issues in the industry. And then, this rise in rates, marketable securities like treasuries, agencies, those price much more quickly than bank deposits. And so now we're seeing competition not only from the fintechs, but from the Edward Jones brokers of the world, but also just, other investments like treasuries and agencies that have moved much higher and quicker to reprice with the Fed moving like it has. And so again, history would certainly suggest, and we've talked about this on our quarterly webinars, that declines in credit quality often can potentially impact liquidity. So certainly things to be considering and monitoring in our banks are certainly our concentrations in our large borrowers. Certainly trying to evaluate and reprice as effectively as we can. We know our borrowers don't want to see that or have to pay it, but we're certainly going to need to be mindful of it as we move forward. I think if we're going to touch a little bit more about these underwater securities portfolios, but in some instances we might have to consider selling some of those for liquidity if depending on where we are. Some of the things that we might be considering as well are just new deposit accounts, and then certainly CD specials, and then if none of those seem to work, or maybe it's a combination of all three, then also potentially utilizing wholesale funding. We're going to talk about cannibalization throughout the presentation. That's always the challenge when you run local CD specials, is making sure or monitoring how much of your own money is going to reprice, and so that never goes away. And I think again, with where rates are and where our cost of funds are, it's more impactful today than even in oftentimes in the past. Additionally, if rates remain elevated, we're going to have to reprice. Many of us are already repricing. Those often outpace the ability to, the increases in our asset yields. So most of us are, going to be dealing with that. And then I think the other challenge is that when you've had this type of almost 18-month run or 12-month run of rising rates, that there's a desire to try to time this thing perfectly, which means we often wait and sometimes miss it. But I think, it's certainly going to be important for us to determine where we jump back in and where and for how long. The other challenge that I think, these elevated rates are with the underwater securities portfolios is right now, it's sometimes convenient or a little bit easier to wave them off as being unrealized, but the longer rates remain elevated, then that does increase the chance, hopefully again, not to come to fruition, but the chance that some of these unrealized losses could in fact become realized losses, which nobody wants to see. And then, again, in 2023, we're going to see an increase in the deposit insurance rate. So, just a number of headwinds that we'll be dealing with as we enter the new year. One thing that, I'm sure you're monitoring at your bank, we're certainly monitoring here at Quick Analytics and Quick Rate, is just the number of banks with, tangible equity issues, right? So, for regulatory purposes, and often, it's not as big of an issue for GAAP purposes. It's potentially a bigger issue for home loan bank advances. It can be an issue. So I certainly encourage all of you to check with your respective home loan bank and make sure you understand the procedures and the processes needed to renew advances if your tangible capital is, it is going to get below zero. As you could see at June 30th, there were 11 banks whose tangible capital or common equity to tangible assets was under zero. At 9/30, that was 31. And so for each of these ranges of tangible common to total assets, you can see the increasing numbers here at 9/30. Again, this is without any credit issues. This is, again, the longer they remain elevated, we might potentially see these numbers increase. So, certainly something to monitor, but from a practical point of view, just make sure you understand the processes and procedures necessary to continue to work with your home loan bank if you are starting to approach any of these levels that could cause some headaches for you. I think one question we've been asked, and I know a number of banks are evaluating, is just the idea of potentially selling some of these securities and then redeploying those money into a higher yielding security, right? It's not going to work for everybody, but there's certainly potentially some securities that you might have that might be coming due that you can at least evaluate the break even or payback if you were to sell those at the loss and then reinvest those numbers. So again, just something to consider. Not suggesting anybody should do this, but I think these are the types of things you certainly want to at least be evaluating as we wind out here for the new year. Are there gains that we can offset with these types of losses and then redeploy? So just a number of different evaluations that might be worth your time to consider and evaluate as we approach year end. Some additional action items to consider is, again, obviously we're always evaluating our liquidity needs. As we talked about, interest rate risk is certainly more taking a front seat role here in the immediate spot. Discussing defensive deposit strategies. I think this starts with identifying potential customers in our banks that might be at risk. I think a report we use at the bank where I'm a director is we're monitoring our top depositors. We're trying to be proactive and reaching out to them to see where they are, to see what they're thinking. Again, certainly you're going to have situations where you're always kind of on the reacting end of this, but I think as much as you can get out in front of those, identify those top depositors, make sure your team knows who they are, your board knows who they are, making sure you're focusing on keeping all of those customers with you. I think another thing that can be helpful here is just revisiting balance tiers. We've seen, like we said, increases in the average balances. Maybe some of the tiers that you have for your products, you might want to revisit those balance tiers as well. We talked about this in our quarterly webinar for Quick Analytics and IntelliCredit. Did we miss an opportunity with those PPP customers that many of us brought in new customers to the bank? Were we able to follow through and capitalize on bringing them or making them core deposit customers as well? And so if we did miss that opportunity, again, maybe we're trying to reevaluate, are there any opportunities to bring in new types of core accounts as well. As I mentioned, monitoring your large balances and certainly any concentrations is important. I think at our bank we're willing to, if we're going to lose a customer, we're probably going to acknowledge that the single relationship account is the one that's probably most likely to leave. So understanding who those are, who your customers are with multiple accounts and relationships, where hopefully the relationship matters. Again, I think having all that information available to your team, making sure you're communicating with those largest customers, thinking about pricing and how you want to approach maybe different segments of your customer base, again, are things, none of these are necessarily revolutionary or earth-shattering, but so much of what we do in banking is execution, right? We just got to execute our plan. And so sometimes dusting off the reminders and just getting back to basics is the best strategy. Organic deposit growth is always the goal. It's always the toughest to achieve. There are, incredible hurdles and barriers to entry. But, again, just some different things we can consider. I'm sure you're talking about, if you are thinking about CD specials, is it new money only? Is it new money minimums? new money matches, targeting those opportunities. But again, trying to make sure we're balancing, bringing in new money with not only not cannibalizing our own deposit base, but also offending our existing customers as well. So, needless to say, this is our goal, but it is often the hardest to execute, and it's always hard to execute when you need the money the most, right? And so, I think for all those reasons, you really have to have a multi-tiered or multi-pronged approach, because it's really when you start to have concerns about liquidity, you really have to make sure you've got all of your available tools at the ready. If you do want to, again, think about different deposit growth strategies, what would a new product look like to complement your existing offering? I think the important thing that we've seen throughout, our 35 years here at QwickRate is tracking those, the cannibalization and the marginal cost is difficult. So try to make sure you do have a good way of monitoring what the impact is or what the migration is of new money into any potential CD specials. Establish, where you want to be in terms of your own maturity calendar. Identify potential customers in your bank who have large non-maturity deposit balances who you might be able to consider and get in front of them with something that, again, while slightly marginal in cost, maybe is not the highest marginal cost. So, going forward, the competition, I think, is going to intensify. I think it's almost impossible today for any of our customers to not be inundated with an offering, whether, again, it's from an Edward Jones broker or that type of relationship, whether it's from a fintech, from another bank or credit union. Our customers are seeing what the rates are on a daily basis, so it makes our jobs that much more difficult. Certainly, I think you have to try to monitor the cannibalization. I know I've talked to a number of banks who, are just, they're just trying to do whatever they can to keep it. So they probably haven't watched it as much as they should. But I think, again, this is not a one or nothing type of strategy, all or one, right? Or all or none, excuse me. You got to use multiple approaches and multiple sources. And we think QwickRate, certainly can be one of those. And I think for years, that's really how many of you have used it, right? That organic deposit growth is very difficult. It's very challenging, particularly, sometimes just in the geography of where your bank resides. QwickRate has been here as a way to complement your local markets. Some of the highlights, just as a reminder, again, we kind of offer opportunities on both sides of the balance sheet. If you do have excess funds to invest, I mean, we've certainly anybody who's been to the marketplace recently has seen the rise in rates, so you can certainly deploy cash. But if you are looking for funding, while it may seem seemingly expensive on a marginal basis, you'll see here it's not that expensive. But again, we've been doing this for 35 years, providing you with a way to raise non-brokered funds. We've been at it for 35 years. You know all of our statistics. We've got a great customer service team. Jen, Zoe, Andrea, Paige, Debbie, all of them, Jane, they'll do a great job of taking care of you. Most of you probably work with them. So we're proud of the service and the team that we've built. And we're here to, again, make sure we can assist you in as many ways as possible, but to make sure we're addressing all of your needs. We recently were recognized and proud to be celebrated as a 20-year ICBA preferred service provider. Our additional services, IntelliCredit and Quick Analytics, have both been named ICBA preferred service providers. So it's a designation and a status we're very proud of. We've worked very hard with. We've worked very closely with ICBA and certainly appreciate the relationship we've had with them. But I think it speaks to the fact that we have done, we think, a very good job of assisting, our banking partners here in our history. So, what makes the QwickRate marketplace different? We certainly have built-in controls. Most importantly, no consumers are allowed. It's institutional investors only. There is that direct relationship between you and the investor. Our e-contact platform, really, changed the game there. And most importantly, I probably from the marginal cost aspect is we avoid repricing your deposits, right? So for that virtual branch that you can marginally pay more money for, but in the grand scheme of things is less expensive for your bank. Over the years, through your feedback and our attempt and desire to make this as smooth a process as we can, we've tried to automate the processes almost, in its entirety. We've continued to take feedback from you, our customers, to improve all areas of the marketplace, and we hope and think we've done a decent job of continuing to do that. In your subscription, you obviously have the ability to raise money on both sides as much or invest as much as you'd like. We'll touch on a little bit later, Debbie Walker, our regulatory director, who's been with us, our most senior employee, and then certainly unlimited customer support in a variety of fashions, whether it's online, through the phone, or through our chat function, are here to assist you. So at this point, I am going to turn the presentation over to Pam, and she is going to walk you through just a reminder of how the marketplace works. Pam?
Thanks, Sean, and thanks everybody for joining us today. Okay, so what I'm going to be doing is going through just really a high level walkthrough of the marketplace, just to kind of give you a feel for how you're going to interact with the investors when you're posting a rate to bring deposits in. Also, we're going to focus on bringing deposits in and the funding side of it, but just know, as Sean's already mentioned, that you can use it on both sides. And we're going to see a few of the investor screens too. So let me share this with you. Okay, so what you should see on your screen right now is this is the Quick Rate Marketplace, and this is post login. So if you visited it pre-login, then it may not look familiar, but I've gone ahead and logged in. The first screen I want to show you actually is an investor screen. The reason I want to take you here is it's really important for you to understand your audience, understand the investors. When you're out here posting a rate, what do the investors see? How do they find you? And what information about your bank is provided to them? So we are logged on live. We'll see current information. And what we're looking at is the view rate screen. So an investor has funds to place today, we'll say, for example, and let's say they have, $1 million that they want to place. They're going to come into this screen to see what rates are currently being offered and what banks are offering those rates. So highlighted is the 1-year term. You can see that we're sorted highest to lowest in that term. But the important thing here for you to look at is our investors want to break their portfolios up into the $250,000 pieces or just below. They want to make sure they stay within the FDIC insured amount. So because of that, you don't have to be the top rate, the top bank on this page to attract attention. And what you'll notice next to some of these banks, you'll see a blue check mark. This is an example of what an investor would see when they log in. Any bank with a blue check mark means they've already placed a deposit with that bank. So there may be several higher than you, but the investor will not go back there to place a second piece. So they're going to skip over any bank with a blue check mark, basically. So in this example, I said they had $1 million to place, and we'll pretend they want to place it all in the 1-year term. They may go to this bank here and put that in their rate cart. It's like they're shopping. But then they're going to have to, they've already skipped over the top two, the next two. So they'd have to go here and here to place their next pieces. And then for that last piece, because they want $1 million, they want under 250, they're going to have to slide down the screen and go here. So it's really just to help you understand why you don't have to be the top rate to attract attention. And we're going to look at another screen where you can see where the activity is happening right now. But we're always going to talk about position. So we say, oh, the 10th position, the 25th position, it's literally where you fall on this page. How many banks down do they need to go? That's your position before they find you. That's what's going to determine how much you bring in, how quickly you bring it in. The other thing I want to show you on this screen is should the investor click on your bank name, if this was you posting a rate, this is where your information appears to them. So at the bottom of the page of whatever bank is highlighted, the investor is going to see, of course, who you are, where you're located, your insurance number. Everyone has to be FDIC insured to post a rate. They'll also see your minimum maximum deposit. Now, some banks will post a higher max deposit, but the reality is, I always say 99.99% because I don't know of all inquiries that come through, but they're going to stay under the 250. I don't want to give you the impression that, oh, if I put a max deposit of, 3 million out there, those are the pieces I'll get. That would be rare, if never. They all want to stay within that FDIC insured amount. So this is really what you can expect. Of course, how you pay your interest, your wire time in and out, there is no settlement period. You're working directly with them. So this is telling the investor, if you wire me those funds as of, in this bank's example, 3:30 today, I'm going to book that CD as of today. Otherwise, it's going to be the following day. And of course, the same with the wire out time. Wire fee in and out, we recommend you don't charge one. As Sean has told you, the majority of our investors are banks and credit unions. They don't want to pay that wire fee. This is not a consumer marketplace. So we would recommend you don't charge one so they don't skip over you. At the very bottom is just a brief snapshot of your financials. You don't have to provide this to us. We get this directly from the FDIC, and of course, are updated quarterly. So that's what's going to show about your bank if you're out there posting a rate. Now, once the investors, are finished looking around, they're going to go to their rate card, and they're going to, simply go in here. They can change anything on here. Of course, they can't change the terms, and what rate you're offering, that sort of thing. But they're going to select all the banks they've put in their cart, and they're going to click send an inquiry. What that's going to do is that's going to send you, whoever on your end you've designated to have that role, they're going to get an email that says you have an inquiry, log into the Quick Rate Marketplace to respond. Now, since I'm not a bank, I am logged on live, but I can't send inquiries or do anything. I have a few screenshots I can show you so that you know what that looks like on the receiving end. So if this is an example of what you, the bank, bringing deposits in your inquiry screen. So in this example, you have 4 investors that have seen you out there on the view rates page. They want to place a deposit with you, and they've sent you an inquiry. Someone on your end got an email, they log into the marketplace and go to their inquiry screen. So there are 4 of them. These 2 have already been responded to. They have a check mark there, but you need to respond to these 2 investors. To do that, you just simply click on their name. You'll have all the information you need about the investor. All of this area will pre-fill the purchase maturity date from the term, of course, the rate that you're offering. Over here, it tells you who the investor is. Of course, in this example, Flag Credit Union, but tells you, where they're located, who their contacts are. This is designed to be a totally paperless system. So you shouldn't need to phone them, fax them, but their information is there just in case. And then you'll have, this is important, is their documentation. These federally regulated institutions, these banks and credit unions, are exempt from the CIP. So you don't have to chase down any type of consumer information. You don't have to send them any of that. All you're going to need from them is a W-9 and a corporate resolution. Now that's already going to be attached to the inquiry. So should you decide to accept this deposit, you'll already have what you need. You don't have to chase any of that down. You simply, to respond to them, you can decline. You're never obligated to accept a deposit, or you can accept it. Once you've accepted it, whoever on their end will get an email that says to log in. Excuse me just a second, I'm so sorry. They will get an email to log in and said to see who's responded to their inquiry. And then, of course, they'll see that you've accepted their deposit. Once you've replied to them, you'll see the blue check mark now in front of their name. So once one person on your end replies, that's it. You can't have several people replying, so you don't have to worry about that. Once they've wired you the funds, We do not get involved in that at all. You're working directly with them, so they're gonna wire those funds directly to you. Once you've received them, you can just select it and then you click post and create safekeeping receipt. That's gonna do a couple things. That's gonna put it into your tracking, should you decide to use any of our reporting or your deposits you bring in, where you can all sorts of different maturity reports and just all sorts of things if you decide to use it. But even if you decide not to use any of the tracking we have, you will want to post it and create the safekeeping receipt. What happens when you do that? This is just an example of a safekeeping receipt. Customer service will help you set this up when you first come on board, where you can, of course, upload your logo. It's going to pull all of this for you, you know, who you are, who the investor is, all the terms of the CD and the rate. And then you'll also enter your early withdrawal penalty, and you'll set that up once. And then once you do, it's already in here. So simply by clicking that post, create safekeeping receipt, QwickRate will create that for you, and it'll post it out there for the investor for whenever they're ready and they want to go get it, they can go get it printed out or just let it ride along with the investment in their portfolio. So again, you don't have to fax this, mail this, it's all part of the system for you. Okay. So as far as view rates go, that's where you appear, that's where the investor goes to find you, and then the interaction between them and you is all done through the QwickRate marketplace. The only thing that you get via email are notifications that simply tell you to log in because there's been activity, so you don't have to sit and stare at the screen all day. But email is not a secure method of communicating. That's why both sides need to log into the marketplace to communicate. So that's how you find each other. The next screen I want to show you is the publish rates. Now, this is a screen for banks that are bringing deposits in. This is where you go not only to post your rates out there, but to determine where to post them. So we're going to go into this little post-it note looking thing here. And what this is, it's going to let you know, hey, where is the activity happening? Because you do need to know what are the more popular terms, because you can be less aggressive there. And also, you know, where are the investors placing their funds? These investors typically want to ladder out their investments. So they're going to see you in multiple terms. One of the reasons we suggest you do post a rate in multiple terms is because, you know, they may come in and have 2 pieces to place in a 6-month term, 5 in a 1 year, you know, a 2 year and a 3 year. They're going to ladder out those investments. So this will tell you where by term the activity has happened. And this is last month, because we're currently in November. In another week and a half or so, you'll see November's activity out there. But as you can see, the 1 year term is the most popular, always has been. So that hasn't changed. But historically, anywhere from 6 months to 2 years is where you're going to see most of the activity. Pretty recently, we've seen this 90-day pop up with some more activity, and 3 years as well. But again, between really 6 months and even 5 years is where you'll typically see historically the activity. So then you want to know, okay, most of the activity came in this example into the 1 year. Where within that 1 year did it happen? So you can drill down a little bit more. And this is just one of the quick tools we have in place for you, so you can do a little research here before you put your rate out there. So I'm going to drill down into the 1 year. So within that 1 year term, where within the 1 year was the money placed? So again, as I showed you on that first screen, we're always talking about positions. This is position 1 through 10. That means the first bank on the page, view rates, second bank, third bank, and so on. What position were they? This is positions 11 through 25, 26 through 50, and then greater than the 50th. So you could see even greater than the 50th position, there's still some activity, but not a lot. Most of it was in the top 10, but you'll see in the 11 through 25, there's still quite a bit, and, you know, some between the 26th and 50th. So, you know, especially if you're a new face out there, ideally you're going to bring deposits in, you know, get out there early, bring your deposits in, have a little bit more time to generate it, and pay less for those deposits. If you need money, you know, right away, overnight, you know, I would post in this top 10. But if you have a little bit of time, especially as a new face, you probably want to start in this area somewhere, maybe 15th, maybe even 20th in those popular terms. And you can start lower if you like, but Keep in mind, you don't have to be that top rate, because remember, they're gonna move down the page to the next new face. They're gonna skip over those blue check marks. So that's why this is important. If you look at a term, say, that's not as popular, maybe you really want 90-day money. Well, let's see where that money's being placed. There's still a little bit beneath there, but there's really none under that. I would say you're definitely gonna probably have to be in here. But anyway, you can see term by term where the activity is happening, or you can simply look on that first screen and you'll see where the money's being placed, and those are going to be the more popular terms. So once you take a look at that, see what's going on out there, you can come into this publish rate screen. We're back in here. And the easiest way to do it is to just select edit rates by market position. This is another tool we have built in for you. In this screen, you can just tell it what position you want to be, and it'll figure it out for you. So let's say you decide, yeah, we're going to post a rate in several terms, popular ones, and we're going to start about 20th. You can literally just type in what position you want to be. So I'm going to pick several here. Say 20th. Do 3 or maybe 15. And then once you're got that in there, you just click set position, and you haven't set these rates. We're just in here analyzing, but it's going to come back and make a recommendation for you. So what it's done, the rank is the position. It's come back and got you as close to that rank as you want it to be, without leaving you tied with a lot of institutions. Sometimes you'll come in here and you'll post a more common rate, like the 1 year 4.851. If you're wondering why it's putting those oddball rates in there, let's just make it a 4.85. We're currently 19th. If you want to post a 4.85, you certainly can, but you'll be tied with 8 other banks, and it's going to move you from, I think it was 19th to 27th position. So they have to move further down the page to find you. So that's why it's giving you those kind of oddball rates. But again, it's up to you. But if you want to take the recommendation, you say, yep, those look good. You'll just put your start and end date in. Defaults to a week, but you can put them out there for a day, for a month, whatever you want to do. What happens if this end date comes and you haven't updated your rates, you'll just fall out of the market. You also have an option to put some limits on it. The holding limit. This is based on inquiries, how many inquiries you get. So let's say you're out here bringing deposits and you want a total of 10 million. You can just tell QwickRate that when I get 10 million worth of inquiries, I want you to do one of 3 things. Send me an email, remove my rates from the market, just pull me out, or lower my rate by so many basis points. Maybe you say, okay, that's all I want, but I want to, keep my rates out there. So lower it by 50 basis points or whatever you want. You can do this also by term. Maybe you don't want to set an overall limit, but you're like, I put a rate in 6 months. I don't want that much of that. So I'm going to say you get 3 months worth of inquiries for this particular term, pull that rate. So you have a lot of options here, or you can just not set any holding limits. You'll probably be monitoring it anyway. But once you have your start and end dates in here, you just click post, and then your rates are out in the market. So like I said, they're very much real time. You'll see banks that can come in and out. It's not crazy activity. You don't have to sit and monitor it, but you can literally come in and out of the market all day if you want. If you post your rates out there and you bring in all you want, come back in and lower your rates, do some bottom fishing, or remove your rates. If you start out lower and you're not getting the inquiries you need quickly enough, you can come in here and bump them back up a little bit to see what kind of activity you get then. So you do have full control here. And remember, you're never obligated to accept a deposit. You have rates out there, and maybe you brought in the last piece you wanted, forgot to remove your rates. You get inquiries, you can simply decline. Try to keep them as correct as you can, though, because these investors are trying to get this money placed same day, and they're managing it. And if you always have rates out there that you're not honoring, they may not reach back out. So, but you can always decline it if maybe you post the wrong rate or something. So just keep in mind you're not obligated. The other thing I want to show you here is rollover rates. You do have the ability on QwickRate to segment your rates even within the marketplace. Maybe you're not really looking for any new money, so you might just have some really low rates out there on the view rates page, but you do want to hang on to those deposits you have that are coming up for maturity. So you may post a little bit more aggressive rollover rate. These can only be seen by investors that have deposits with you. So these will be seen by those deposits that are maturing, and the investors have the ability to come in and send you an inquiry, just like the rest of the communication, but it would be on rollover rates. So that's one of the nice features. If you decide not to roll those over and you want to let those deposits roll off, you can post out here a request wire, which is going to tell them, we're not rolling these over, please send us your wire instructions. So again, designed to be a paperless system, so you don't have to be calling or faxing or mailing back and forth. You should be able to communicate everything right through the marketplace. Okay, there's a lot of different resources out here. Again, I want to stay really high level. If you'd like to do a one-on-one demo, just reach out to us and we'll schedule a time to do that so we can take our time, show you a lot more of it, and then answer any questions. Also, customer service, when they do your training, they will go through everything with you. It's real simple to get up and running. They'll usually the training lasts about an hour, so it's really easy. I'll point out just a couple things. So under resources, we have a lot of different resources, but one of the things Sean's already mentioned, Debbie Walker, who's our regulatory specialist, she has a lot of different articles and links to things and information out here, kind of frequently asked questions, if you will, about not only quick rate specific, but also, out of area funding. And this may be really useful to you. My profile, you can have as many users as you like. I think Sean may have mentioned that. But whoever you have designated as an admin, which you can have a couple of them, they can actually add users at different levels of authorization. Do a lot of different things within QuickRate as an admin. Of course, you wouldn't want everyone to be an admin. Some of the levels of authorization are who can post rates. Maybe you have 5 QuickRate users on your end, but only a couple of you can post rates. You can set an authorization to only give those people access to that. You may have several others that get the emails from the inquiries so that they can respond to those. So again, customer service will go through that with you, but there's a lot of different levels of authorization that your users can have. And again, as many as you need. The last thing I want to show you, Sean has made reference to the cost of funds and cost of running local specials. And we do have a lot of tools built in here for you. I'm just going to show you one. This is the cost of funds calculator. And as you see, it can help you determine the true cost of funds associated with raising local deposits. So what this is going to do, I'm going to go in there and we're going to do just kind of an example so I can show you what it's showing us. And you can come in here and put your numbers in here if you're thinking about running a local special and just see what that's going to look like. So what it's looking for first is those types of accounts that you already have, the deposits you already have, and things like money market, savings account, those that are most in danger of moving if you were to run a CD special. So we're going to use the example of, let's say you have 50 million currently in those types of accounts in your bank. And then what are you currently paying on those? What's a blended interest rate you're paying on those money market and savings accounts? So we'll say you're paying 50 basis points, maybe lower or higher, but for this example, we use that. The next thing it wants to know is you're running a special. How much, are you trying to raise? How many new deposits do you need to bring in? We'll say 5 million. We'll be conservative here. And then the last one is a special CD rate. So what this is looking for is not your lobby rate. It's talking about if you were going to run a special on CDs, what type of rate in your local environment would you have to offer in order to get activity into your bank? Not just the lobby rate, but to generate some new deposits, new money. So let's say your local market, we'll use a 3.5. And we're going to pretend that's going to have them knocking your door down. They're all going to come in for that rate. So with these numbers, we'll just simply hit calculate. We just want to show you how this works. What this is showing you in this example, if you were to run that CD special, and let's pretend, as Sean mentioned, what percentage is repricing, what percentage is moving out of those money market and savings account is difficult to track. But let's say it's just 20%. 80% of the money, you're bringing in, it's all new money. But a percentage of the money you already had sitting in money market and savings account that you're paying a 0.50 on, 20% of that actually saw that rate, that special rate, and said, I'd like that too. And it moved into that special CD. What your effective rate is, what that new money actually cost you, that 5 million, is not the 3.5 that you offered in the special, it's 9.5. If 20% of that money sitting in your money market and savings moved over to that rate, and the conversion cost was $300,000. What it's telling you, there's the cost of the new money is not only the rate you offered, but what you're paying on top of the money that moved. So now you're paying more for a certain percentage of deposits you already had. So it's taking the cost of that, those deposits moving, adding it to the cost of the CD special and giving you what your actual cost of running that special was and bringing in that 5 million, which is paying a 9.5 rate and 300,000. So it can get, obviously, if you have a higher percentage moving over, that number goes up. If you had to offer a higher rate for that special, that number goes up. So it can be very expensive to run those local specials. So you may just want to pop in here, look what your numbers look like when you're considering, running a special. You might want to look at this first, because again, if you bring deposits in through QuickBonds, you do bring it in quietly. It's a closed institutional marketplace. There are no consumers or individuals. Your local depositors will not see the rates that are on QuickBonds. So hopefully that makes sense. We also have an explanation. It's pretty simple math, but exactly where we came up with those numbers, it's out here if you ever want to look at that. And I think really, as far as the marketplace, I think that's all I wanted to share. Hang on one second for me. I'm going to grab another screen. Oops. Okay. And then the last thing, I want to talk about is, of course, what we just looked at, which, was the real-time information, direct funding. We focus there. Of course, as I mentioned before, you can certainly invest through QuickBonds if you like, and we can show you that other side if you're interested. I've touched on a little bit of the reporting and tracking, but there's a lot on both sides, and then some of the quick tools. And I believe Sean already talked about these. So Sean, I will hand it back over to you.
Okay, thanks, Pam. So we have a question come in. Is there a way to see how many potential investors are in the system looking to place funds? No, unfortunately, that's part of the reason we suggest you always post a rate, because while there's activity every day, we don't know the exact ins and outs of when our investors are going to be looking for funds, right? And so, the fact that this is a virtual market, and, we do encourage you to post rates when you need it. Pam touched on the fact, the longer you give yourself, the more, opportunity you give yourself to bring in funds at a lower price. So, again, I think that, is another reason to do that. We also had a question about the slides today. Those will be available. I always forget to do this at the top of the broadcast. We will send a link to today's recording, as well as a copy of the PDF as well. And then just again, a final note on the cannibalization that Pam touched on, right? Is that it is it's tough to see that headline rate a lot of times when you come into QuickBonds, but when you start to consider the impact of that cannibalization, it does make a whole lot more sense why this market can complement what you're trying to do in your local markets. So all right, so let's just talk a little bit more about the regulatory perspective. I'm sorry, Pam, anything you wanted to add about on the question that we had about seeing the investors?
Yeah, as Sean mentioned, I mean, we can't tell you on any given day who's out there and what terms they're going to. You can see historically through, you remember on the published rate screen, how much money was placed the prior month. But investors, just like issuers, are in and out of the market, so it changes day to day.
Great, thank you very much. So just a couple of notes on the regulatory perspective. Certainly, for our 35 plus years, we pioneered the non-brokered, listing service definition. We have a complete risk management workbook that Debbie Walker has put together. She has a due diligence pack for you. So again, everything you need to go do to get up and running, we have available to you. With the changes to the definition of a broker deposit that went into effect in 2021, nothing for our marketplace changed. So no worries about the deposits you raise here in the Quick Rate marketplace. As Pam mentioned, and I mentioned as well, Debbie Walker is our Director of Regulatory here. She's our most senior employee. And again, many of you have probably worked with her. But if you do have any questions, she is the resource immediately available to you through Quick Rate to answer any of those types of questions. Just kind of a recap of what we think, some of the benefits of a subscription with Quick Rates, right? Obviously, the ability to quickly connect and turn yourself on to unlimited funding and investing. As Pam showed you in the walkthrough, we've got a number of different quick tools that help automate the process and hopefully streamline it as much as we can. We've listened very hard to you, our customers, to try to improve our marketplace over the years, and we'll continue to do that as we move forward. And then finally, we're proud of the fact that our team has been together for, most everybody here almost 20 plus years. So I think when you work with Quick Rate, you come to expect and should expect a level of service in terms of, getting back to you, answering questions and doing everything we can to make sure your time in the marketplace is successful. And then I just wanted to close with QwickBonds. So this, in an attempt to continually evolve with the market, making sure we're meeting our bank's needs, we developed a solution called QwickBonds. It can be found on the toolbar. I'll show you here in a second. This is a screenshot, but you do have the ability to also invest or sell securities. So we show you the rates that are out there. And we also, more recently here, we've had a lot, you can ask for requests for quotes on selling any of your securities. We can execute those as well. This is already available to you as a Quick Rate subscriber. So there's no additional fee to do this. Obviously, since these are securities, we would just need your delivery instructions so they can be delivered to where you safe keep those. But this is a solution that is available to you. I just want to show you again where you can find this on the Quick Rate marketplace. So when you click on this tab, it opens up a second browser window for you and takes it to a new page. Again, you can buy municipals, you can buy mortgage backs, you can buy agencies, treasuries, you can sell those as well. So as we mentioned, you can ask for bids to get price quotes. You can request bids on any existing bond or even offer up your bonds for sale. And then, like I said, we've got those different offerings listed out here in the different terms. We provide information about the securities available. And again, all these can be delivered right to your safekeeping provider. So again, just wanted to give you a quick show of that. It is available to you as a Quick Rate subscriber. So please reach out to us or reach out to Matthew Coe, and he can walk you through it and talk to you about your current situation and see if there's any application here for you as well. Kind of wrapping up, just a reminder for any of you who are unfamiliar with some of our other offerings, including Quick Analytics. It's a comprehensive tool for bankers, include interactive bank pages, bank and peer performance, and regulatory tools such as CECL. We've had a tremendous response from our users this year, particularly around the CECL tool. So again, if you're still looking for a solution, please reach out to us and we'd love to show you. In 2019, we also introduced a new service called IntelliCredit, where we provide external third-party loan reviews, but we've also built an application that you can use internally at the bank, both for portfolio analytics as well as internal and annual reviews. So again, we have webinars upcoming on this that we'd love to show you what we've built and how we can help you. Certainly, if there's any questions, go ahead and submit those in the Q&A function right now. As I mentioned, if we can help, reach out to us. If you want to talk more about the marketplace, if you'd like pricing or just talk about different scenarios, you can reach us at the 800 number shown there. You can email us at info@quickrate.com or reach out to Pam, Ricky, or Melissa on our sales team. As I mentioned, we continually try to provide webinars. We have upcoming CECL webinars in December with our coffee talk installment in December, as well as another introductory demo webinar on December 8th. Paul Allen from Saltmarsh will be joining us as a guest panelist in December. And then finally, as I mentioned, we do have a best practices for loan review coming up on December 6th. So we'd encourage you and certainly welcome the opportunity to show you what we're doing here. And if you're looking for a bid for a loan review, we'd certainly welcome the opportunity to provide one of those to you as well. All right, Pam, any final comments before we let everyone go for the day?
I don't think so. Just thank you everyone for joining us. We appreciate your time. And as Sean said, just reach out to us if you'd like to schedule a one-on-one demo where we can go into more detail, or if you would like to discuss the pricing or have any questions at all, just let us know. We'd be happy to get right back to you.
Thank you, Pam. Thank you all very much for joining us. I hope you found it helpful. We will work to provide more discussion on liquidity next year on it. As we suspect, it'll be somewhat of a challenging year. We want to thank you for taking time out today to attend. Thank you for working this at Quick Rate. Have a wonderful Thanksgiving, and please let us know if we can help you in the near future. Thanks so much. Have a great day.
Thank you.